Let's get into determining the cost of the residential unit. A lot of things that we might think would constitute as a cost that we can include in the 10-20 year deduction might not constitute. For instance, a fence around the building does not constitute as a cost to the residential unit. And so you have to sit down with an accountant or with a professional to really knead out those parts of the building structure that you've got going on that do qualify for the act. Let's take this example to help us understand in a very basic way. Again, it is extremely nuanced. You need to be able to take into account a lot of things when it comes to your development that you want to invest into or even build for yourself. It is important for you to understand the application of this law. But as a very basic example, to get us to understand this, here it goes. In February 2016, Company A bought vacant land for $5 million and built a block of flats consisting of 20 residential units that was for use by their employees. And this cost them 10 million rand. Company A owns a parking area alongside the building at a cost of 700,000 rand and a security fence at a cost of 400,000 rand. The residential units were all let by the end of the year in December of 2016. Company A also owns 10 residential units in South Africa, which are let to various tenants. The result of all of that information is this. Company A qualifies for the 5% allowance for 20 years. Under Section 13, Section 1, the cost of the land, the parking area, and the fence do not qualify for the allowance as those costs are not part of the costs of the residential units. Therefore, the allowance is not apportioned to the 700,000 rand and the 400,000 rand. So this is how it applies. 10 million rand times 5% gives us 500,000 rand that Company A is able to use to deduct off of their tax liability for the next 20 years. This is very important. You are able to apply it as a deduction. Say, for instance, your tax liability was 350,000 rand and you have in excess 250,000 rand. That 250,000 rand is not rolled over into the next year, nor is it claimable as a cash refund. It is just simply a deduction that is applicable when applicable. The block of flats, again, does not qualify as a low-cost residential unit because the cost of the build exceeds 300,000 rand. I hope this is helpful and that we understand in its most basic form that this is a great allowance that you're able to essentially claim back a large chunk of the amount you spent. So it might not be 100%. You're able to claim back at least 100% of what is qualified as the cost of the new and unused building. Here are some general costs that will not be included in the cost of the new and unused building. The cost of the land. You cannot include the cost of the land as the cost of the building. The cost for preparing the land. So costs related to preparing the land, costs related to rezoning, costs related to any kind of finance costs or interest costs related to some form of financial instrument that you use to acquire the land or the building. However, certain types of costs that are very linked to the building, so your direct costs such as your engineering fees, your architectural fees, all of those types of things can be included in the cost of the building. These are just simply outlines. SARS might be able to make allowances for different types of costs if it makes sense. So when it gets to these types of tax laws, there's a great framework in place, but there are a lot of things where if it makes sense, it can be included into the deduction. There is a lot more to learn about Section 13. Please feel free to click the link. Once you click the link, you're able to click book a consultation and we can sit down and chat about how this could potentially be applied in your individual capacity, in your company, or just in your future plans for investing in property.